The Nasdaq is setting up one of the most dangerous divergences I've seen this year. While QQQ rallies to 709.66, the weekly MACD is actually rolling over. This is the exact pattern that preceded the August 2022 squeeze. I'm watching 703.40 like a hawk. If that breaks, we are looking at a 5% correction minimum, full breakdown and my exact trade setups on the main video. Link in description. Don't get caught on the wrong side of this move. Let me show you something that most retail traders are completely missing right now. It's the kind of subtle divergence that separates the professionals from the gamblers. The QQQ closed at 709.66, up 3 points and 37 cents, a seemingly tidy gain of 48 basis points. But beneath this facade of bullish stability, the weekly chart is screaming a warning that I've learned to respect after 2 decades in this game. I'm not talking about the daily noise or the headline chasing. I'm talking about the structural breakdown that's happening at the highest time frame, the one that actually pays out when the music stops. We are seeing a textbook bearish divergence between price and momentum, and the last time I witnessed this exact constellation of signals, it preceded a violent 6% unwind in just 4 sessions. Welcome to Alpha Market Meridian. This is the Nasdaq 100 breakdown you didn't know you needed to. Here's my call straight out of the gate. I am cautiously bearish on QQQ with a short-term negative bias for the next 3 to 5 trading sessions. That doesn't mean I'm looking to pile on shorts indiscriminately. It means I see a higher probability path down toward our first major support at 696.37, with an extended target at the S2 level of 693.50. The invalidation level for this overall bearish thesis is a sustained daily close above 718.50. If we take that level with conviction, the entire bearish divergence narrative is off the table and we need to reassess. But right now, I'm positioning with a tilt toward the downside, looking for high conviction shorts against resistance and breakouts that fail. This isn't guesswork, it's a measured response to the weight of the evidence. Let's start where the smart money lives. The weekly chart. It's the time frame that filters out the noise and reveals the true institutional footprint. On this time frame, QQQ has been in a defined uptrend since the lows of late 2025. But what I'm focusing on right now is the relationship between price and the momentum oscillators. Price has made a slightly higher high at 710, but the RSI on this time frame is peaking at a lower level. This is bearish divergence, and it's not subtle once you know where to look. The weekly MACD is also slowing. The histogram is shrinking despite price making new highs. I've seen this movie before. This level reminds me of the August 2022 squeeze when the same liquidity grab fooled everyone into thinking the trend was unstoppable. Back then, the divergence preceded a 7% correction in less than 2 weeks. I'm not saying it's a perfect repeat, but you would be wise to respect the setup. Now coming down to the daily chart, price is resting just above the daily pivot at 708.48. This is a critical inflection level. The daily RSI sits at 58.2, neutral on the surface, but trending lower after failing to break above 60. The ADX is at 24.6, suggesting the trend strength is weakening. The bears are building a case. The MA20 at 701, the MA50 at 698. These are the key levels you need to have marked on your chart. We are trading above both, but the question is, for how long? I'm watching the daily close against these levels more than anything else right now. On the 4-hour chart, things get even more interesting. The recent price action has formed a series of lower highs since the peak at 713. This is a classic topping pattern, and when you overlay the CCI at -47, you see a loss of buying momentum that can't be ignored. The 4-hour structure is clearly distributional. We have a mini head and shoulders forming with the neckline around 703. A break of that level on high volume could accelerate the move down. My personal rule is to always wait for confirmation on the lower time frame before committing capital, but the 4-hour is already giving early warning signals. Finally, at the 1-hour chart, we've got the most immediate actionable picture. Price is chopping between 706 and 711. The hourly RSI is at 51, dead center, which suggests indecision. The ATR on the hourly is 2.6, relatively tight. When we see volatility contract like this after a divergence, we're usually about to see an explosive move. The question is direction, and the evidence suggests a resolution to the downside. This is where the story gets really interesting. The headline news driving QQQ is a cocktail of mixed signals, but the underlying current is unmistakably bearish. The core CPI data came in hotter than expected, showing a 3.4% annualized increase versus the 3.2 forecast. This is a critical data point because it pushes the Federal Reserve further from any rate-cutting path. I've been saying for weeks that the market was prematurely pricing in rate cuts, and this inflation print is a reality check. What stands out to me is not the headline CPI number itself, but the 10-year yield reaction. That's where the smart money is watching. Yield spiked to 4.89% on the back of the print, and when you see real yields moving higher in tandem with a falling Nasdaq, that's a dangerous combination. The geopolitical backdrop is adding another layer of pressure. The tensions in the Middle East continue to drive a bid for safe haven assets, and that bid is coming at the expense of growth-oriented tech names. It's the classic risk-off rotation, and it's accelerating. I'm also watching the oil price surge. Crude is up 15% over the last 30 days, a direct headwind for consumer discretionary spending and corporate margins. Tech companies are particularly vulnerable to these input cost pressures. Looking at the upcoming 3 to 5 day calendar, the key event is tomorrow's PCE deflator number. This is the Fed's preferred inflation gauge, and if it comes in above expectations, we could see QQQ test the 693 support level much sooner than anyone expects. Friday brings the University of Michigan consumer sentiment, a leading indicator that could either confirm or contradict the consumer spending narrative. These are the catalysts that traders will be positioning for, and the technicals are already telling us which direction the smart money is leaning. I'm also keeping an eye on the ECB commentary and any surprises from the Bank of Japan, both of which could have ripple effects on the dollar and, by extension, Nasdaq valuations. Let's get into the meat of this analysis. I'm presenting 2 scalp setups for the next 24 hours and 1 swing trade for the week ahead. Scalp setup 1. The inside bar failure. This is a high probability scalp for the next 24 hours. We've seen an inside bar pattern form on the 4-hour chart, indicating extreme compression. My entry zone for a short is from 708.50 to 709.50. This is just below the recent daily pivot and offers a favorable risk-reward entry. Stop loss at 711.30, above the recent swing high and the resistance zone. Take profit 1 at 704.20, the first layer of support on the hourly chart. Take profit 2 at 701.70, the MA20 level. The risk-reward ratio for this scalp is approximately 1 to 1.5 on the first target, and 1 to 2.5 on the second, providing excellent asymmetric risk. Invalidation is a sustained daily close above 711.30. Scalp setup 2. The breakout trap. This setup is about capitalizing on a false breakdown. My entry zone is a buy at 703.50 to 704.50. But only if price first breaks lower below support and then reclaims that level on the hourly chart. This is what I call the breakout trap, and it's a pattern that I've used successfully countless times in my career. Stop loss at 701.20, just below the MA50 level. Take profit 1 at 707.80. Take profit 2 at 709.60. Testing the recent highs. Risk reward is around 1 to 1.7 for the first target and 1 to 2.8 for the second target. Invalidation is a daily close below 701.20, which would signal a true breakdown. Swing setup. The week ahead position for the swing trade. I'm looking at a sell on rallies over the next 5 days. My entry zone is 712 to 714. This is the resistance area identified by a 2 at 713.50. It's also the area where I expect institutional selling pressure to emerge if we see a relief bounce before the next leg down. Stop loss at 718.50, which is just above our invalidation level. Take profit 1 at 703.20, take profit 2 at 696.30. The risk-reward on this swing trade is approximately 1 to 1.5 on the first target and 1 to 2.6 on the second, making it a compelling risk-reward. Trade invalidation is a sustained daily close above 718.50. Before you execute a single trade, I need you to understand my non-negotiable risk management rule. No single trade should risk more than 1 to 2% of your total trading capital. I've been in this game long enough to know that even the best setups can fail. I was trading during the 2020 COVID crash, and I had a long position that looked perfect from every technical angle. I was up 3% in the first hour of trading. By the end of the week, that position was down 12%, and I violated my own risk rules because I became emotionally attached to my thesis. That mistake cost me dearly, but it also taught me the most valuable lesson of my career. The market doesn't care about your analysis. It doesn't care about your hopes. It cares about price. So manage your risk like a professional. Use those stop losses, take your profits when they're offered, and never let a small loss become a catastrophic one. I'm sizing my QQQ positions at 0.5% risk per scalp and 1% risk for the swing. It's not flashy, but it ensures I survive to trade another day. Here's where we stand. QQQ at 709.66 is at a critical juncture. The bearish divergence on the weekly chart is the most compelling technical signal, and the fundamental backdrop of sticky inflation and geopolitical tensions only adds weight to the downside case. The key level I'm watching is 711.30. If we close above that, the bearish narrative is in trouble. But as long as we hold below it, I'm looking for shorts towards 696.30 and beyond. This is the tape that traders make their year on. I'll be back on Friday with our weekly wrap-up, breaking down the price action and adjusting the forecast for next week. On Sunday, I'll release a pre-market update that gives you the edge before the Monday open. So make sure you've subscribed and hit that bell. If you found value in this breakdown, drop a comment below and tell me your target level for QQQ this week. Let's see who's reading the tape correctly. This is Trade Meridian Decoded, and I'll see you on the other side of the trade.